By now, you've heard the headlines from the 2026 federal budget. Tax cuts, big changes to negative gearing, a shake-up of capital gains tax. So I'm not going to just tell you what changed. You already know the shape of it. The question almost nobody answers is the one that actually matters now. The dust has settled, so what do you do about it? Because the people who come out ahead after a budget are rarely the ones who read it on the night. They're the ones who quietly adjust their plan in the weeks afterwards, while everyone else has already moved on. And with a new financial year about to begin, this is that moment. So I'll go through 3 groups: people on a salary, anyone thinking about property, and people who already invest. For each one, the practical move, what to set up now, and what to do once the new rules are live. One quick note before we start: some of this is still going through Parliament, so I'll flag what isn't locked in. And none of it is personal financial advice. If your situation is complicated, a short chat with your accountant beats any video. Okay, let's talk about what to do. If you earn a salary, the budget is about to put a bit more in your pocket. From the 1st of July, the tax rate on income between $18,201 and $45,000 drops from 16% to 15%, and then to 14% the year after. On top of that, there's a brand new Working Australians tax offset. It's a permanent offset of up to $250 on the income you earn from the 1st of July 2027. More than 13 million workers get it. And it even covers sole traders running their own business. You don't apply for it. It's added automatically when you lodge your tax return. It also lifts the effective tax-free threshold for workers to nearly $20,000, which is the biggest permanent lift to that threshold in over a decade. Add it all together. The offset plus the rounds of tax cuts phasing in, and from the 2027 to 28 financial year, someone on average earnings is keeping around $2,500 more a year than they were a few years ago, and up to around $2,800 once you count the new instant deduction I'll come to in a moment. Call it a bit over $200 a month. Here is where most people lose it. A pay rise you didn't ask for is the easiest money in the world to let slip. It lands quietly, it gets absorbed into everyday spending, and a year later, you genuinely cannot say where it went. So decide where it goes before it arrives. In the next couple of weeks, set up an automatic transfer for roughly what you expect to gain into your mortgage, your offset, a savings account, or an investment account. Redirect it before it ever touches your spending account and you keep it. Wait until you feel a little richer and you won't. Then, once the new financial year starts, check it actually happened. Look at your first couple of pay slips after the 1st of July. Confirm your take-home has moved, and set that transfer to the real number. One more, because it changes your admin going forward. From the 2026 to 27 income year, there's an instant $1,000 deduction you can claim on work-related expenses without keeping a single receipt. Around 6.2 million workers will use it, with an average saving of about $200. The only question for you is whether your genuine work expenses come in under $1,000 or over. Under, and you can stop hoarding receipts for every small thing. Over, and nothing changes. You claim the actual amount the usual way instead. And things like charity donations and union or professional membership fees, you can still claim on top of all this. Work out which one you are now, not next July. Now, property. This is the biggest structural change in the budget, and the right move depends entirely on where you stand. If you're trying to buy your first home, the change helps you, but slowly. The reforms are meant to cool investor demand for established homes over the next 12 to 18 months. Don't hold your breath for a crash that may not come. What's expected is that the competition you keep losing to at inspections eases gradually. So don't just sit and watch. Get yourself genuinely ready to buy so you can act when it does. A real pre-approval, not a hopeful online estimate. Your actual borrowing capacity, including how your HEX repayments affect it. And tidy spending in the months before you apply, because banks look back further than most people expect. Readiness is the whole strategy, because a softer market only rewards the people prepared to step into it. If you're thinking about property as an investment, the maths has genuinely changed. On established properties from here on, you can no longer offset rental losses against your salary. And for a lot of people, that was the whole reason the numbers worked. So, model any purchase without that offset, and see honestly whether it still stands up on its own. If property is still your path, the concessions now sit with new builds. And if you already own an investment property you bought before the change, you're grandfathered, your setup is untouched, and there is nothing here to do in a panic. This is about new purchases, not the one you already hold. Which brings me to the group with the most at stake and the most noise around them right now. People holding investments they'll one day sell. From the 1st of July 2027, the flat 50% capital gains discount is being replaced. In its place, your cost base is adjusted for inflation, and there's a new minimum 30% tax on the real gain. Let me make that concrete with one simple example. Say you buy $10,000 of shares, hold them for 5 years, and sell for $20,000, a $10,000 gain. Under the old rules, you'd be taxed on half of it, which on a 30% rate is about $1,500. Under the new rules, your original cost lifts with inflation, say by $1,600 over those years, so you're taxed on roughly $8,400. With that 30% floor applying, you'd pay around $2,500. Same gain, about $1,000 more tax. And the bigger the gain, the bigger the gap. Two things make this far less alarming than it sounds. Super is completely exempt. And I'll come back to that because it's the real opportunity here. And anything you already own keeps the 50% discount on its growth up until July 2027, so this only touches gains from that point on. Now here's the move, and it is not the one the panicky headlines are pushing. Do not rush out and sell to beat the deadline. There are two good reasons. The first is tax drag. Selling now triggers a real tax bill today, pulling money out of your portfolio that would otherwise keep compounding for years. The second is that time in the market beats timing the tax. The market itself moves far more than this change does, and selling early to dodge a future rule usually costs you more in lost growth than the rule ever would. So instead of selling, know your number. Sit down with your accountant over the next year and work out what selling under the old rules looks like compared to the new ones for your specific situation. Then, if you ever do sell, it's a calm, deliberate decision rather than a scramble in the middle of 2027. And one sharp detail worth knowing: the 30% floor applies no matter what your income is. So the old trick of selling in a low-income year while you're on parental leave, say, or stepping back from work, no longer saves you the way it used to. There is one genuinely positive shift to make here, and it might be the most useful thing in this whole video. Super was left untouched by these changes, which quietly makes it more attractive than it already was. Inside Super, earnings are taxed at just 15% and nothing at all once you're in pension phase. And there's a timely nudge here too. The concessional cap, which is the pre-tax amount that can go into Super each year, including what your employer puts in, is rising to $32,500 from the 1st of July. So if you've got room under that cap, directing a bit more in through salary sacrifice now does more for your long-term wealth than it did before. But, and this part matters, it is not Super versus everything else. It's Super and everything else. Money in Super is locked away until your preservation age, and if there's any chance you'll want to step back from full-time work in your 40s or 50s, you still need money you can actually reach outside of Super to bridge that gap. So lean in a little if it suits your timeline. Just don't lock away money you might genuinely need before then. And a quick word on what I would not be doing, because the biggest risk after any tax change is overreacting. I would not sell a whole portfolio to dodge a rule that's a year away and might still change before it lands. I would not switch out of Australian shares into international ones to escape it, because the same rules apply to both. This is a moment to stay steady, not to make sudden moves you might regret. So let me pull it together into what you actually do, whichever group you're in. If you're on a salary, automate the tax cut before it arrives so it builds something instead of quietly vanishing. If buying a home is anywhere on your horizon, get genuinely mortgage ready now so you can move when the market loosens rather than scrambling to catch up. And if you already invest, don't panic sell. Know your number, lean sensibly into Super, and keep clean records of what you own. Because the value of your investments on the 1st of July 2027 is the line that splits the old rules from the new, and you'll want that tidy well before you need it. That's the whole theme, really. A budget rewards preparation, not reaction. The changes themselves are mostly out of your hands, but the move you make in response is entirely yours. And that's the part that decides whether a budget works for you or just happens to you. And if this left you feeling a bit more in control of where things are heading, subscribe and stick around. Calm and prepared instead of anxious and behind is exactly what I'm here for. If today got you thinking about your own numbers, this is the part where you actually do something with them. I have built one workbook that holds your whole financial picture in the one place. Your tax, your super, your debts, your savings, and your long-term investing. With every formula already done for you, you type in your real numbers, and the maths runs quietly in the background, showing you exactly where you stand and what each decision would actually do to your future. All of it built for Australian tax, Australian super, and Australian property, so the numbers are right for where you actually live. I run through every tab of it, start to finish, in a full walkthrough video. I have linked it just below. Go and see your real position, then come back and watch it change.